So this particular video will focus on lessons learned from the last few years of what has transpired in the commercial real estate market. And these are lessons learned observing many sponsors, operators, fund managers. As you know, I run a podcast with a cheesy name, Big Mike Fund Podcast. Many guests on the podcast. I know many top fund managers, syndicators, operators, and talk to them quite often. And learning from the experience, my own and their experience. So let me go through some of the really important lessons that come to mind without picking on anyone. Not picking on myself, not picking on any operator. Some of these lessons are very industry-wide lessons, and some are specific to a given deal or a given operator. So let me just start from the top. Number one, really understanding risks in every economy and understanding market cycles. So risks, there are many risks on any given deal, and there are economic risks. Rapid changes in the interest rates, up or down, is a risk. Obviously, interest rates falling is typically tailwind, supports the market. It's really not acting as a risk, but as an opportunity. While when the rates are low, the risk of rates rising is high. So we were in a very low interest rate environment for a long time, and the Federal Reserve accustomed us to the ZIRP, zero interest rate policy, for too long. And when they withdrew that, they withdrew the ZIRP cocaine, and rates went up fast and furious. We wound up in a rapidly shifting, dislocated market because of the higher for longer interest rates. So that was a risk. And from a cyclical perspective, we were at the peak of the cycle because the interest rates were very low and everybody was trying to buy. The number of buyers in 21 and 22 was very high. There was sort of a fight for deals, bidding wars. When those things happen, you're likely approaching peak of the market. So lessons learned again, risks like interest rate risk, where you are in the market cycle, from supply demand, where the mass is going, you got to be going in the opposite direction. Back to the Warren Buffett, be fearful when others are greedy, and be greedy when others are fearful. What's really interesting, the reverse is true too, of course. Now we are sort of in a reverse condition, where the rates are high, and they have no place to go but down, right? If you think about it this way. And from a cycle perspective, there are a few buyers. Everybody's walking scared, fearful, concerned. So these are very important lessons and observations one can make to see where there's a peak or the bottom of the market, as well as obviously risks or opportunities ahead. So those are two real basic elements, but we're going to cover many more. So next one, we're going to talk about underwriting standards, looking at various variables, looking at the assumptions. And a few years ago, many investors, operators, sponsors, fund managers, the market was for, let's call them, more aggressive assumptions. Why they were aggressive? Because that's what everybody was used to. They were assuming faster rent growth. They were assuming interest rates would stay at a certain level. They were assuming ability to execute projects, achieving certain occupancy, etc. And they had no room for error. So what's really crazy about underwriting, they also had no limited cash reserves. Everything was focused on maximizing upside ROI, not thinking about downside protection. So one of the key lessons learned in every deal is not just to look at the upside, but look at the risks and downside protection. And how do you increase downside protection and you mitigate risks? Well, increasing interest reserves, general reserves. Having more cash available could make a big difference. A few deals, we're budgeting enough of that buffer, and it's a lesson learned in general. When you look at new deal, more conservative underwriting assumes things are going to go more difficult. Some unknown problems may appear, etc. So changing underwriting standards for lower rent growth, for somewhat more difficult execution, for unknown problems, and putting more cash aside is a critical lesson learned for many operators. This is a non-cyclical lesson. This is a general, more conservative philosophy, better way to underwrite from a more conservative point of view. Next, position on the capital stack. So when the market was hot, everybody wanted to enjoy the upside. They were looking at the target IRRs, bright and shiny objects, not really paying attention to the risks of a common equity position on the capital stock versus looking at preferred equity versus looking at mezzanine and secondary debt versus primary debt. So all those points matter depending on individual risk tolerance, depending on the individual objectives. Participating in common equity may or may not be the right opportunity or the right type of deal that folks should be looking at if they're looking for capital preservation and more conservative thinking. There are still opportunities that exist in debt, for example, mezz debt, where you could get equity-like returns without equity-like risk. Of course, there's risk in being in secondary position on mezz debt versus primary debt. So it's really all a function of individual needs, preferences, risk tolerance, etc. So lessons learned, don't look at the bright and shiny objects. Look at what's right for you, for your investment strategy, for what makes sense. So again, it's just understanding the difference between risk reward on a capital stack on every deal. So we've seen this on deals where in the distressed market, the property gets sold, common equity gets wiped out, mezzanine debt and primary debt gets paid in full. So on a situation like this, there's a humongous difference between the experience and the results depending on where you're participating on a capital stack. So those are some of the really quick lessons that come to mind. There are many other ideas. It's a continuous learning process. Of course, focusing on who you invest with is a primary goal. So picking the best operators, sponsors with the best track record, with the best values, integrities, abilities, and also realizing when you have a great, strong, honest operator that runs into difficult market conditions, yelling and barking and screaming at them doesn't help. Really need to understand how to work together to solve problems. So solving problems is not an easy skill, and not every operator shows the people show their colors during the time of difficulties a lot more during the time of success. Unfortunately, it takes a long time in real estate to really understand who are the quality operators versus who are the people who are sort of high flying during the good times and they're going to crash hard during the bad times. So again, judging people, underwriting operators, learning how to do better job there is very important. So these are some of the key lessons learned. There's many more, but I just wanted to give you a few quick thoughts to give you a little bit of the flavor of what fund managers like me go through, thinking through the process, to learn myself and to share with others to get better at this. This is life is a journey. Investment is a journey. It's a journey to becoming an extraordinary investor or a better investor. It all takes time, and sometimes you win and sometimes you learn, like in the book. Until the next time, thank you.